Live.
Yeah.
You are live.
Okay, first of all, good morning.
Morning.
We're welcoming a new member to the commission, John Ortlieb, and the battalion chief, I think, is on this call.
That's correct.
Good morning, welcome.
Good morning. How are you?
Good.
Morning, John.
So our longstanding policy on this commission is that there is no bad question as we go through and we look at reports and or our meeting with the managers. Please feel free to ask any question on your mind. Chances are it will help all of us get a little better insight into what our managers are doing.
And only Joe will make fun of you. The rest of us won't.
Yeah, but I'll do that on my second computer, not the main one.
All right.
The other item is just let me express both a personal appreciation and one I'm sure from the city for all of you and all of our members who are serving the public during these difficult times. And from what I was looking at what's happening in Annapolis, it looks like you'll have even more difficult times in the next few weeks with crowd control and managing the needs of the public. With that said, first item of business, I believe, is to approve the minutes. Did anyone have comments on the minutes of the last meeting? And for the battalion chief's benefit, the way we handle the commission's meeting, because so much of what we do is in executive session rather than open to the public hearing, is we have two sets of minutes, one for the public session as well as one for the executive session. And so let's go first here for comments on the public session minutes, if any. And if not, I'll take a motion to approve those.
So moved. So moved.
Second.
All in favor?
Aye.
Any opposed? Okay, with that, those minutes are carried. Let's see. I think we are moving on. We just. I don't think we have any old business matters to address. So we will jump to the presentation from Ian Jones, our consultant, on the market environment generally. And so Ian, it's yours.
All right. Thank you, Joe. And good morning, everyone. I'm going to share my screen. Can everyone see that has a computer in front of them?
Yes.
Yes.
Great. First of all, I apologize for filling your mailbox up last night and this morning. There's one manager accolade, which is the private equity allocation. And Yoon, my assistant on this relationship, informed me that she had not included accolade in the total assets. And I'm glad we noticed it because, and this is as of November 30, which is a sort of manual estimated process, but it was nice to be able to add that in last night because we gained another 0.5% in the month of November, which is great. So I'm going to start off, the investment topics that we're going to cover today. We're going to review performance. We're going to talk about Edgar Lomax as a follow-up to the discussion at the last meeting. There's also a question at the last meeting about the asset allocation structure of the state of Maryland retirement system. We're going to touch on that. We mentioned at the last meeting that Aberdeen has a collective investment trust and has a lower fee. So we did an analysis of performance on a net of fee basis. We're going to share the details on that. And at the last meeting, we heard from Aberdeen, and there was discussion about possibly having another meeting, a special meeting, where and I think potentially we would invite Aberdeen to sort of talk about the global markets and global themes, because they had a fair bit of detail in their report, and we didn't cover that. And so possibly getting together to discuss that. And I'll give an update on where we stand with the Brookfield Supercore documentation. So the month of November was a pretty phenomenal month in the equity market. And with the performance that we saw transpire in November, we are pretty much in positive territory in all parts of the market, with the exception of large cap value. And November was one of the best months on record in decades. And there's a direct correlation in November with market performance and positive news. And the positive news these days is relative to vaccines to curb the virus. And with that, we had a shift into parts of the market that had been the laggards, and that are potentially going to do better in a recovering economic environment. And it's interesting, my comments today are the same as they were 2 months ago, is that, you know, on the downside back in February and March, the market went down for fundamental reasons, because businesses were shutting down, you and I were shutting down, you know, lockdowns, and we basically had a lot of uncertainty, and the economy was poor, and equities went down 30+% because of those fundamental reasons. And then late in March, the equity markets started to go up, and the markets went up more so for technical reasons than fundamental reasons. The technical reasons were government stimulus and, you know, any positive news, and the positive news has changed over time relative to the virus. But we had a phenomenal recovery, and from the market lows, we are now up. I'm just going to point out some numbers here, and I have this figured out how to draw a red box around stuff. But you can see the red box that I just drew. Since the low on March 23rd, the S&P 500 is up almost 64%. Mid-cap stocks are up almost 80%, and small cap stocks are up over 83%. And that now brings us, you know, firmly into positive territory. Year to date, you can see through the end of November, the S&P 500 is up 14. Mid-cap stocks are now positive, up 6.7, and small caps up 10.4. And the thing I point out is that we've seen a rotation where mid and small cap had trailed year to date. But if you just look at the month of November, and that's under MTD, mid-cap stocks and small cap did quite a bit better than the large cap part of the market. You can see up 14 and 18+%. And the other noteworthy factor is that with the positive news on the vaccine front, the stocks that will do better in a recovering economy contributed most. And those are principally stocks on the value side. So you can see value represented by the Russell 1000 value was up 13.5%, and growth was up 10.25%. And that's because of the performance of stocks like, going down here, like energy and financials. And there are more energy related companies and financial related companies in the value benchmarks. And they contributed the most to performance in the month of November. Why? Because there's a notion that when the economy recovers, that more people will get in their cars, more people will get on planes, more energy will be used. And the more cyclical part of the the economy that are tied to the consumer and business and commerce will do better in that environment. So we've been waiting sort of for that shift, and we've seen it. Now, whether or not it'll last, time will tell. You can see the performance is still quite substantial, coming from the FANG stocks. Those stocks still up substantially on a year-to-date basis. But when you look at their performance in a month like the month of November relative to the broad market, those stocks are in single-digit territory, where other parts of the market are in double-digit territory. We also seen positive contributions coming from the international markets, and we've seen a nice rally in the developed international markets. Developed was up 15.5% in the month of November, and that was pretty significantly negative. And you can see with that 15.5% return year to date, the developed international markets were up 3%. So we really needed that 15% return in order to get into positive territory. And the emerging markets, led by China, are up about 10.2% through the end of November. So very positive results coming from equities. On the bond side, we still have positive results coming from bonds, 7.3% return from the investment grade. That's the highest quality part of the bond market. And we're back into positive territory in high yield bonds, a 5.1% return. High yield bonds were hurt pretty significantly in February and March, but you can see over on the right-hand side, they're up 31% since March 23rd. Kathy had asked about, what do I foresee for 2021? And first of all, when you look at domestic equities, it's hard for me to imagine that we can continue to grow from a performance standpoint at the pace that we have in domestic equities. We have had, unbelievable returns. If you look at the 10-year numbers, over here, the S&P 500 over 10 years has returned 14.2%. That's relative to a historic average going back to 1926 of a little bit better, about 10.5%. So above the historic average over the last 10 years. And, companies are fairly expensive relative to the earnings that they're generating. And I just have to assume that with the challenges that we are continuing to see with the virus, and just listening to the news this morning, with various people talking about what to expect, for the balance of December and leading into the spring, it just seems like we have, continued challenging environment ahead of us, and I don't know how that translates into more profitability for the broad economy or for broad companies. But I think at some point the markets have to, they will recognize the fundamentals, and I think those fundamentals, will temper the rate of return coming from public equities. However, I do think there are going to be opportunities. I think on the value side, particularly as we march forward into a recovering economy, there's I think a lot of value companies that are cheaper relative to the earnings they generate, and I think there's opportunity there. So we may see continued contributions coming from the cheaper part of the market. And I also think we can potentially see opportunities coming from international, because in general, international, if you just look at the performance over the last 10 years for international, I'm going to highlight developed international and emerging market over the past 10 years, 5.8 and 3.6% returns. And I think they there's more opportunity there from a valuation standpoint, and that could be the next, part of the global economic or global equity markets that could lead. I think we have to really temper our expectations on the fixed income side. The Barclays aggregate index is only yielding 1.2%. And I think my personal belief is I think we sort of go sideways for a while in the fixed income arena, and we get, very modest rates of return. And I think we will see better rates of return coming from the credit sensitive parts of the portfolio. The parts that haven't done well, we've seen a lot of recovery in the credit parts of the portfolio that are higher risk but higher opportunity, and hopefully we will continue to see those add value relative to investment grade bonds. I think we'll continue to see challenges on the real estate side, particularly from office and retail. And I don't think we've seen the full impact from real estate yet. Many believe that we're not going to see as much of a downdraft as we saw in like 2009 following the global financial crisis. But because we entered this environment with, I guess, better occupancy, lower debt, better overall health at the property level of companies. And so I've heard people in the real estate industry say we're not going to see as much potential depreciation, but I still have to assume we're going to see some impact from the retail sector and the office sector based upon the challenges created by the virus. Any questions, Kathy? Any questions from you?
No, thank you. I appreciate that. We're hearing a lot about tailwinds, on pent-up demand and things like that. And so I appreciate your very even-handed approach to how we're looking at this. So does that enter into your factors at all, this pent-up demand issue? And
well, I do think there's parts that, when we talk about pent-up demand, I think that, some of those areas of pent-up demand could be in the value sectors of the market.
mm-hmm.
And, I know just from talking to friends, there's a lot of pent-up demand for people to travel. I'm not really looking to travel, but, leisure and entertainment, airlines, those are parts of the economy which may benefit when, people, do start to travel. But I just don't see that happening until, the latter portion of 2021.
Right. I agree. I agree.
Based upon what's happening now, I don't know. It seems we really need to have this vaccine, and I think that's going to help a lot. But from what I hear, a lot of us, aren't going to even get that until spring or early summer.
Right.
But I do think that positive news is going to continue to translate into some good days in the equity market. I think that, anything that the government is going to do with respect to additional stimulus is also going to, translate into, better, some good days in the equity market. But, one thing that people say is not going to happen anytime soon, but I think is a concern is, when is all the stimulus going to take hold from the standpoint of like inflationary pressures? And right. I think we've increased the money supply like 5-fold, but we have not seen the price of goods and services bid up. Now, and I'm not exactly sure, because like when I don't go to the grocery store much, but seems like things are expensive when I go to the grocery store. We're trying to get some tile work done in our house. We can't hire a tile person. Like it's out into February, March before we can get someone to come and tile at the house, and it's not cheap. So it seems like to me that there's, things are more pricey, but I guess it's maybe bigger items. Housing, here in Buffalo of all places has gone up pretty significantly. There's a lot of demand. But I'm concerned eventually, about rising interest rates. And I think that, I think the market can potentially continue to do well with moderate early, increases in interest rates. But I think, depending upon what the government does at some point, if we get into a stronger economic environment, if we get up into, an environment where we're seeing more inflation, I think eventually higher interest rates is going to be bad for the equity market.
Right. Well, and that kind of brings me to my last question, which is, with all the money cash sitting on the sidelines, and as people start to get some certainty, they've got some certainty about the election, and now they're getting some certainty about the vaccine, that cash may start to come back in. The only place to get any return right now is in equities.
Yeah.
Not CDs, not anywhere. So that amount, those dollars will begin to come back in, I think, mid-year 2021. So.
Yeah. Joe and I, had a chat yesterday. It's something I mentioned to him that I think currently the low interest rate environment contributes to a lot to the demand side of the equity market, because, investors, and particularly, there's a lot of retail investors that are staying at home, and they, to a certain extent, they are partly responsible for like the FANG stocks, being bid up in price, and investors aren't willing to accept a 0.75% or 1% return from an intermediate to longer term bond.
Right.
And but the FANG stocks, it's not like they're making a ton of money. They've gone up appreciably in price, but they're pretty expensive relative to the earnings that they're generating.
Right.
And I think eventually, and maybe we're seeing it right now, that those stocks sort of level off a little bit, and they just can't keep going up at the pace they have. Just look at the returns in the FANG stocks for the last 10 years. For the ones that have been around, they've annualized out between 26% and 33%. And just, that's enormous growth. I just don't see them, staying on at that pace.
Right. All right. Thank you so much.
You're welcome. Joe, that's my comments on the market environment. Do you want me to go on to the performance report?
I think we would need to go into executive session to go into those discussions. And so with that, I think we should move into executive session.
We need a motion, please.
Someone has to unmute themselves.
Move
So
we,
moved.
yeah, second,
Second.
Thank you.
Those in favor?
Aye.
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 And then those opposed?